Welcome back. Let's shift our focus now to the North American auto and auto parts sector. Our next guest says he does not expect steep tariffs to be imposed from the United States. Let's bring in James Picarello, Senior Automotive Research Analyst at BNP Paribas. He joins us now from New York. James, thanks a lot for joining us. A lot gets made of the fact that the North American auto sector is really a continental sector, that auto parts cross borders many times before a finished vehicle rolls off the assembly lines. Is that something that will affect the decision-making of the U.S. administration?
It absolutely will. Right, when we think about Mexico production, for instance, 35% of GM and Stellantis' North America production comes from Mexico, and 2/3 of that in Mexico ties to pickup trucks, which are extreme profit centers, right, for these automakers. And so when we think about the latest, Trump soundbite of a 25% tariff on any vehicle coming from Canada or Mexico, you're looking at a $7.5 billion impact to GM if they don't pursue any mitigation efforts. Of course they will. And for Stellantis, it's something closer to $6 billion. Right? We're talking about almost half of GM's 2024 profit, either EBIT, being exposed to a 25% tariff rate. And that does not take into account all of the additional supply chain costs. Right, 20% of U.S. production, 20% of the bill of materials are components that come from Mexico. And when you factor in the many layers of the supply chain, a component that is a U.S. component actually crosses the border from Mexico a few times potentially. And so you're talking about maybe half of the bill of materials for a U.S. produced vehicle having exposure to Mexico. So I'm not all that fearful of a 25% type of tariff, because it would be extremely detrimental to the U.S. industry. And I think, we have to think about what legacy does the administration want to leave behind?
It would be very detrimental to U.S. buyers of automobiles, too, if I understand your rationale.
Someone would have to eat that cost, right? Whether it's the automaker or the automaker trying to pass it to the consumer. But when we think about U.S. sales volume from here, right, we finished 2024 at a very, very solid 16 million units from 2023's 15.6. I'm thinking about 2025 at 16.2, so low single-digit type of growth. And what really drives that? OEM pricing coming down about 2 points. You've got some dealer profitability that needs to normalize and to the benefit of the consumer. If we're thinking about dramatic price increases because of these tariffs, right, we would also have to consider volume, pretty substantial volume declines in terms of U.S. industry volumes.
Okay, so what you do expect is something of a repeat of what we saw in the first Trump administration. Remind us how this all settled in the first Trump administration.
Yeah, exactly. This is all deja vu. During the first administration for Trump, right, we went through all of these draconian costs and the potential of, what does the rewrite of NAFTA to what is now USMCA, what does that look like? And at the end of the day, USMCA required additional U.S.-based value-add sourcing requirements. So that stepped up from 62.5% to 75%, which has proven to be very manageable for automakers. And for non-compliance, the tariff rate for those vehicles stayed the same at 2.5% for passenger cars and 25% for pickup trucks and vans. And so, yeah, we're going through that same scenario of now, right, thinking about extreme costs around a 25% tariff. I think the reality is going to be something much softer.
Okay, in terms of stocks, you say GM is best positioned, and you favor the OEMs, the original equipment manufacturers like GM. And certainly when we look at GM stock, it's off its peak, but certainly the stock does not reflect any sense of panic about incoming tariffs.
Yeah, exactly. And GM has a lot of operational momentum. They're executing exceptionally well, and that execution is playing into their market share gains. They're gaining. They gained market share throughout 2024, while their incentive spend, their discounting, trended below the industry average. So they're incentivizing and cutting their price less than the industry, yet still gaining share. And so that tells you they're putting the right product in the right regions at the right price point. And there's momentum that should sustain in 2025 for GM, and then they've got other company-specific catalysts, such as they're cutting their Cruise, their autonomous driving robotaxi operation. So that's $1 billion in annualized savings. They're heavily restructuring their China business, which is another $500 million. So yeah, despite pricing coming down for all automakers, including GM, would be my expectation. There are a lot of positive offsets to that negative pricing.
James, thanks a great deal for your insight. James Picarello, Senior Automotive